Okay, let me just go back over here for a second. Let's take a look at some of these reports. And eh, one of the things that I did already, let me just kind of show you. This is the balance sheet. Now, the balance sheet has changed. Um, and when I looked at it initially, it was 850,000. Now, remember that there's a difference between the trial balance and the balance sheet. And the trial balance we have on the debit side, we have this $50,000 here for vehicles. And on the credit side, we have the 20. So all we're doing is adding those numbers up. And when we do, because we don't have any offsets there, we're having 870,000 on the left side, 870,000 on the right-hand side. When we actually put together the balance sheet now, this 20,000 comes off of the vehicles because it's a sub account that's reducing the vehicles. Now, the balance sheet you're looking at here, I've already done some of these entries. I just wanted to check to make sure that that everything is working like it's supposed to. At this point, though, after I've done several entries, you can see that my balance of 856,750 here and 856,750 down here is uh, done. So all right, so let me just come back over here. I want to show you some invoices and show you the invoices that I created and basically how I did it. And of course, you could have done something with this, but I'm not that interested in that. Those are kind of the finer points that you can work on later. Okay, so I'm going to just show you this particular invoice, this Jones. And so what you had to do was you had to create Jones Building Supplies, and I just, as I told you to do, I created Jones Building Supplies and then just I made up an address for them. Okay, and then what I did in order to get this at where it's at is I did invoicing. Okay, and I went through invoices right here, and I had to create the customer because it didn't exist before. You could have come through here and created the customer first. And if you want to go through and just create all your customers, you can certainly do that. Actually, it's probably a lot easier to do it. I think that sometimes when you're creating them on the fly with this online stuff, it may create a little bit of a time lag for you. It did for me, where I had a lag problem. All right, so I actually have three different invoices here that I created. Um, and the one that's kind of interesting is this one here. These two I just set up because they're invoices, and I don't think I don't think that well, I know that neither one of those were paid. Okay, but let's take a look at Levinson, because what happened with Levinson was that we invoiced them for 5,000. Okay, and so this was the initial transaction here. And so what I did was I set up Levinson again. I did the invoice, which in this case was 1,002. I charged them billboard revenue. Make sure that for all three of these revenue streams that you create a revenue account, so you have three different revenue accounts. I'm less concerned about whether you get the expenses side exactly right in terms of, is it an advertising expense versus a promotion expense or what? I'm not that terribly concerned about that, but I do want to make sure that you have the print revenue and the billboard revenue, and I think there's one other one. Uh, and some media revenue probably or something like that. It's three or four of them anyway. And so I created this and then called the description billboard revenue and charged them $5,000. And then I saved that. And the second thing that you have to do then, and I'll come back over here. And the second thing you have to do is when you after you've got that, you've got to receive your payment over here. Okay, because remember what happened here. We sold them $5,000 worth of stuff, but we got 2,500 in cash, and so you have to set it up as the 5,000. And since you didn't get it all in cash, and then received the payment immediately thereafter for the 2,500. And so then that, after you've done that, then that'll leave you with this $2,500 balance, which is what you were looking for. On the expense side, and you have to set up the vendors as well. Um, in this case, I think, let me just look at vendors here and see what I've set up. I may not have added all the vendors yet, so you'd have to add your vendors, and probably a good idea to add the vendors first. But since these two that I did here were paid in cash, I didn't worry so much about the vendors yet. If I'm setting somebody up that they're going to pay me on credit, then I have to set the vendor up. But in this case, we paid both of these items, the initial 300 and the 200, we paid it in cash. And the first one was just some office supplies, and the second one I think was for some business cards. So I treated that as advertising and marketing expense. Again, the key is if you treated both of those as office supplies or both of those as advertising and marketing, you're still going to have $500 in expense, and I'm not going to quibble about that so much. But the main thing is that you have the $500 in expense. So when I go through here, or went through here, I should say, I'm not trying to give you every single one of these entries. I think that it's probably a good thing for you to work through and see, and that's the way frankly, I'll kind of separate you um, as to whether or not you know what you know how to do this stuff. Um, but let me just walk down through here because most of this, like pay the electric bill for cash. Okay, well, if you paid it in cash, do it the same way. You'll take a look and you'll have expenses, and you know at the and then I'll tell you what. Let's just do the water bill, okay, so that you can see that. Um, so let me have an expense here, and I'm going to create an expense and a new transaction up here, and it's an expense transaction. And what kind of an expense is it? Well, I'm going to call it let's see what we got here. Insurance, interest paid. And by the way, you got the interest paid there. So when you get down to the point where you're doing your payments of um, your payment on your truck and all that sort of thing, make sure you're splitting those. And I'll show you what I'm talking about here in a minute. But okay, here's utilities. So good deal. All right, and the amount of utilities that I'm paying. But look up here on the top because I want you to notice here that this is coming out of the cash on hand. And who did you pay? Well, that one, we don't have the payees set up, but you probably would want to set it up. I didn't set them up, but you should probably set them up by, add new, and then the new name would be utility company or whatever, Georgia Power or whatever. Okay. Not so interested in that part, but they're a vendor. Okay. And save it. And so then now you have Georgia Power coming out of cash on hand. And how much did we pay? Well, over in the amount side, we paid $90 for cash, or $90 on the water bill. Okay, and save it. And what I want you to see is that look at your cash balance up here, 289.5, and now you notice it's 289,410. The reason it was 289.5 is we started out with 287.5. We paid out $500. We brought in $2,500, which brought it up to 289.5. And now we paid out $90, which takes it down to 289,410. Okay. All right. So that's that part. Let me just pop over real quick to, if I can find it here. Got so much stuff up. Let me pop up here to the amortization schedules. And what I told you was that you have to create your amortization schedule for your new truck. And I had the beginning balance in there. I didn't have this stuff in. And the way that I got here to these, all right, well, it's in two steps. So the first one is I have to determine what the payment amount is. So equal. And well, it's easier for actually probably for you to come over here and do FX and find payment. So you just type in PMT here, and now you get your payment and double click it. And the rate is 0.12 divided by 12, or you could put it in as 0.01. But the rate here is 12%, but it's per month when you're paying on these. Second thing is it's an 84-month payment. And the final thing is it's a $71,500 vehicle. And so when I click OK, it gives me $1,262.17. Now that's the payment that includes the interest. All right, so now to get this number, what I did was I said it's equal to this times, and you could go the same way. You could go 0.12 divided by 12, and that gives you 715. Or you could say 0.01. Either way, it doesn't matter. And now the principal is going to be equal to this number here. And what I would probably do if I were you is I would probably come down here and do something like this. It's equal to this number times -1. Now you don't have to do that. You could just say that it's this number, the absolute value of this number, but I'm changing it from a negative number to a positive number to make it easier up here, okay? And then what I'm going to do is I'm going to say that my principal balance here is equal to whatever's in this field right here minus, well, let me back up. I don't want to do it like that. Equal to this number here and make that an absolute value. So it's an F4. And notice that puts my $sign in front of the column and $sign in front of the row. And then subtract from that this number here, because this allows both numbers to float, okay? And so now 547.14. And to get to this number, it's going to be equal to this number here, your beginning balance minus your principal. Because the interest doesn't come off of your balance, just the principal does. And then this number over here is going to be equal to this number, because the ending balance becomes the beginning balance for the next month. And now if you can actually come down, you should be able to come down through here and drag these down. And you notice that this number goes down a little bit. The interest payment goes down, the principal payment comes up, and so forth. And then you do that for the entire 84 months, which I think are already scheduled out here. And when you get down here, it should be 0. The ending balance should be 0. And if it's not 0, you probably did something wrong. Okay, real simple. Okay, so that tells you how to do that. In terms of the depreciation, and I'll just do quickly and show you what you would do on depreciation. Now on the new truck, and you'll have to do this probably for your others as well, but on the new truck, you have 71, now I'm going to put this in parentheses, a 71.5. And I think I told you that the salvage value on the truck is going to be 13,000. And that's the numerator. And it's going to be divided in this case by 90 months. And the reason it is because just because you are only paying 84 months doesn't mean that the truck's only valued for 84 months. In this case, I tell you on the other side in the someplace over here. Over here, I tell you up here at the top that, or no, maybe it's not at the top, maybe it's at the bottom. Wherever it is where you're doing the depreciation, it's over here someplace. Okay, record depreciation on a new truck, assuming that it has an 8.5-year remaining life, 90 months. Okay, and a salvage value of 13. Okay, so that's where I get the 90 months. And so it's $650 a month, and that's your depreciation. To debit the depreciation expense, vehicles, credit accumulated depreciation vehicles. And remember, when you set these accumulated things up, that those are always sub-accounts. So that when you set it up there and you make that entry to debit the 650, and probably do it through a general journal entry, frankly, um, and do a general journal entry, debit your depreciation expense, vehicles or building or whatever, credit your accumulated depreciation, vehicles, building, whatever, and make sure that you treat the accumulated depreciation on all of those guys, all those fixed assets, except for land, of course, as a sub account, and that should take care of it for you. Okay, so that's kind of where those things all end up, and it should be fairly straightforward. I don't think I'm going to do any more of them for you. You'll probably have to set the. There's one up here that somebody had asked about. It had to do with. Oh shoot, who was that? Mary Contrary, I think. She bought like $750 of printed brochures, and then she found a little error, a typo error, okay, down on October the 19th, or in your case, probably be better, January the 19th. She found a typo on the brochures and agreed to keep the use, but demanded a 10% discount, which we allowed. So what you're going to have to do is um, go back and treat that as a return, okay? And treat it as a discount or a return. And so you're going to debit the accounts payable Mary Contrary and credit, excuse me, you're going to, let me think about this for a second here. I want to make sure I tell you right. You're going to debit the discount amount and credit the accounts receivable. I'm sorry, it's not accounts pay, it's accounts receivable from Mary Contrary. So debit the discount or the return, whichever one you have. If you've got a discount, that's what you need. And then credit accounts receivable, Mary Contrary. I got confused there. I was thinking about we owed that, but no, they owe us. So and so what you would do here is, when you set this up, you're going to have an accounts receivable or an invoice for $750 for Mary, and it's not going to be paid in cash; it's going to be an invoice, and then you're going to go back into Mary Contrary and do a return or a discount for this 10%, in which case you're going to reduce her accounts receivable because she's not going to owe you that much. And okay, one more thing here, and then I'm going to call it a quit here. When you are recording your interest and your principal, all of these are set out for you with the exception of the new truck, which you have to do. And in this case, you're going to um, when you write this check or um, um, create the check for the payment here. What you're going to do, and you notice here it's 19/18/56, right? Okay, which is, if I look at this number, I can tell right away that 1600 plus 3/18/56 is 19/18/56. And if I add any of these two numbers together, I'm always going to get this 19. What's going to change though is every time your interest expense will change and your principal will change. Okay, your principal meaning you're going to debit the interest expense for 1600 in this case. You will debit the accounts payable current portion, or the notes payable current portion for in this case, the building, and you're going to credit cash because it's going to come out of your cash account in the amount of 19/18/56. Okay, well, I think that does it for me for this one. And I think what you should do then is to go through, and if you're having problems, let me know and we'll work through them with you. All right, thanks a lot for paying attention. See you later.